Hello, this is Alicia Sisk-Morris, and today I'm sharing with you financial reports, which are a portion of the accounting department's responsibility. First, I'd like to share with you a visual representation of the chart of accounts. The chart of accounts is a listing of the names of the accounts that the company has identified and made available for recording transactions within the general ledger. The company has the flexibility to tailor its chart of accounts to best suit its needs, including adding accounts as needed. Within the chart of accounts, you will find the accounts listed in the following order. The balance sheet accounts here will be listed together. They include assets, liabilities, and owners or stockholders' equity. And the income statement accounts will be listed here, which include operating revenues and expenses, non-operating revenues and gains, and non-operating expenses. Oftentimes, we see the chart of account actually match up against the organizational chart within a company. So you can, when it comes time to create your own chart of accounts, you can look at your own company's chart, organizational chart, and lay things out in such a fashion. For example, if a company divides its business into 10 departments, production, marketing, human resources, etc., each department will likely be accountable for its own expenses, salaries, supplies, phones, etc., and each department will have its own expense account, so its salary accounts, and etc. So they can actually have their own departmental financial statements that will ultimately be combined to form the company-wide financial statements. Here's an example of what a company organizational chart might look like, and as you can see, as it's broken down, each of these departments would have their own subfolders or sub-accounts within the chart of accounts, so they can actually be held responsible for the income that is generated within their department, if it's appropriate, and the expenses that occur within their department. So they can actually track their actual expenses against their budget. This is an example of what a large corporation's chart of account would look like. As you can see, again, they're all broken out by category, but within each category we see it broken out further by division. Next, we will take a look at the balance sheet. The balance sheet is one of 4 main financial statements within a company's structure. The balance sheet is also joined with the income statement, the statement of cash flow, and the statement of stockholders' equity. The balance sheet itself displays the permanent accounts, bank accounts, loans, equipment, and buildings. It represents the accounting equation, assets equal liabilities and owner's equity, and reflects the financial condition of a business on a particular date and time. When it comes to analyzing the balance sheet, oftentimes you will use ratios to measure profitability, liquidity, and financial strength. You can compare assets and liabilities over time. You can do a working capital analysis as well as leverage, which is the debt over worth. And remember that all balance sheet analysis is done based on the concept that this report is done as a snapshot in time. As any events change within the corporation, their balance sheet will obviously reflect those changes. Here's an example of a sample balance sheet. Our assets are up here, which include current assets, investments, property, plant, equipment, intangible assets, and other assets. And then on the other side of the equation, we have our liabilities and stockholders' equity. Our liabilities consist of current liabilities and non-current, and of course our stockholders' equity is here at the bottom. And as we have discussed previously, our assets must always equal our liabilities plus our stockholders' equity. That's the basis of all double entry bookkeeping accounting systems. Now, the current assets are going to be composed of things such as cash and cash equivalents, short-term investments, accounts receivable, inventory, and prepaid expenses. Our investments will consist of long-term investments in companies, the cash surrender value of life insurance policies, things like bond sinking funds, real estate held for sale, and cash that is restricted for construction of plant and equipment. Of course, most folks are familiar with the idea of property, plant, and equipment because it consists of costs of land, buildings, machinery, equipment, furniture and fixtures, and vehicles used in the operation of business. Finally, we look at our intangible assets, which are things that you can't touch, but are nonetheless assets of the company. They would be considered things like goodwill, trademarks, patents, copyrights, and other non-physical assets are required at a cost. And finally, our other assets consist of things like bond issue costs and certain deferred income taxes. This is one way we can use to balance the books, but not one I recommend. On the other side of the balance sheet, we have our current liabilities. This section consists of loans payable that will be due within a year of the balance sheet date, the current portion of long-term debt, accounts payable, income taxes payable, and liability for accrued expenses. Our non-current asset liabilities are things that are due after 1 year, so that's going to be the portion of the automobile loans, portion of mortgage loans, bonds payable, and deferred income taxes. And finally, we have our stockholders' equity. This is the section of the balance sheet that consists of paid-in capital, retained earnings, as well as treasury stocks. And treasury stocks are actually subtracted, as they are the amount paid to repurchase a corporation's actually owned stock. Please keep in mind that the balance sheet and the income statement are actually linked documents. Next, we'll take a look at the income statement. As we mentioned earlier, the income statement is the second statement in the four main financial statements. The income statement is called also the profit and loss report, the P&L report, the statement of operations, and it displays income expenses over a specific period of time. Reports are generally printed monthly or quarterly or at year-end. When it comes to analyzing the income statement, you can do things like measuring the ratios of profitability, such as gross margin and net income. We can also do growth trend analysis, comparison to similar businesses, comparison to prior year or current year, and also calculate the return on investment. The income statement comes in two formats. There's the multi-step and the single step, and we'll take a quick look at both of those. The multi-step consists of the first subtraction resulting in a subtotal called gross profit. The second subtraction consists of us generating our operating income, and our third subtraction provides the bottom line net income. Here is an example of what that form would look like. As you see, we have our sales, and we subtract our cost of goods sold to get our gross profit, and then later we subtract our selling and general administrative expenses to get our operating income, and finally we either add in our interest income, and then we subtract out our interest expense to get at our and drive to our net income here. Now in this single step income statement, we're essentially boiling down this process to just one calculation or one subtraction. And this is what this single income step statement looks like. We have all of our positives, our sales, our investment interest income up here, and we get to a total of total revenues by adding those two numbers. Then we take all of our expenses, lump them together down here, add them up, and we come to total expenses, and derive net income by taking our total revenues and subtracting our total expenses to come to that $10,700. Please keep in mind that $10,700 is identical to our multi-step income statement. We're driving to the same net income number. We're only changing how we are formatting it. Next, we'll take a look at the cash flow statements. I know many of us think this is our vision of cash flow within the company, but other companies may envision their cash flow a little more like this. Just reminding you that the cash flow statement, again, is one of the four primary and main financial statements that are available for a company to look at. And here's how the cash flow statement is organized. We have our operating activities, which is where we convert items reported on the income statement from accrual basis back into accounting for cash. The investing section or investing activities is where the reports the purchase and sale of long-term investments in property, plant, and equipment. Then we have the financial activities section, which reports the issuance and repurchase of companies' owned bonds and stocks and payable dividends. And finally, supplemental information section, which reports the exchange of significant items that did not involve cash, but reports the amount of the income tax paid or the interest paid for that transaction or transactions. So let's take a look at it. We have our current assets and liabilities. Those come from our balance sheet, and they will be reported on the operating activities section of the cash flow statement. We have our long-term assets, which will be showing up in our investing category on the cash flow statement. And then we have our long-term liabilities and stockholders' equity, which are reported on the financing activities section of the cash flow statement. Here is an example of a cash flow statement analysis. As you can see, we start the year off with all zeros. So this is a brand new company. And by the end of the year, we will after 6 months, we will drive to this statement of cash flow balance sheet. And this is where we end up with some cash in the bank, some inventory, some office supplies. We'll also have purchased some office equipment and reduced it by our depreciation. We're showing some influx of capital from Matt Jones, our owner of the organization, and will reflect some net income for the business. When doing the cash flow analysis, we'll take that net income of $280, which comes from this form over here, that $280 right here, and we'll be adding back our depreciation. We'll be subtracting our inventory since we paid cash for it. We'll be subtracting our supplies that are sitting on our balance sheet since we also paid cash for it. We'll also subtract the increase in office equipment since again that was a full cash outlay. But we'll be adding back in the financing activities of the owner, where our owner actually infused $2,000 into the business. And then we come to the formula of we take our net increase in cash plus the cash at the beginning of the year, and that will end up with our cash on June the 30th, 2014, which is actually our 6-month point. And just to give a little fun at accountants, although we are number people, we do just want to have a little fun. Finally, we'll take a look at the fourth financial statement called the Statement of Stockholders' Equity. This statement is a financial statement that shows all of the changes to the various stockholders' equity accounts during the same period of the income statement and statement of cash flow. It will include all amounts of comprehensive income not reported on the income statement. This account is the exact difference between the asset amounts and the liability amounts. The stockholder equity is also called the book value of a corporation. Sections of the stockholders' equity include common stock, paid-in capital and excessive par common stock, preferred stock, retained earnings, current year's net worth, and treasury stock. Here is an example of what a stockholders' equity section would look like. And here's an example using the numbers. Our common stock here has a par value of 10 cents, and we multiply that times our shares outstanding, and we get to 2,000 shares that have been authorized to drive to our $200. Any funds paid in addition to that 10-cent par per share will be going into the paid-in capital excessive par common stock. Then we'll take in our retained earnings for the year, and we'll drive to our total of stockholders' equity. I'll also give you a brief discussion on the difference between common and preferred stock. With common stock, an investor gives a corporation money in return for part ownership. The corporation issues a certificate of ownership interest to the stockholder, and the certificate is known as a stock certificate. Common stockholders elect the board of directors, vote on mergers, and get a huge return if the company is successful. Stock is evidence of ownership interest and is not a loan to the corporation. Preferred stock is a class of corporate stock that provides preferential treatment of dividends. Preferred stockholders will be paid dividends before common stockholders receive dividends, and they usually do not share in the corporate's earnings, and instead they receive a fixed dividend. Now, retained earnings are reports that the net income of a corporation since its inception until the balance sheet date less the dividends declared from its inception to the date of the balance sheet. And finally, treasury stock is a corporate's own stock that has been repurchased from the stockholders, and it's usually reported at the cost that it was repurchased at on the statement of stockholders' equity. And I'll conclude with sharing with you some of the users of accounting and financial information. Our users are on the left and our applications are on the right.